Hello, everyone. I greet you, whatever time zone you're in right now. This is the voice of Ken Akure. And in today's class, we'll be doing some introductory aspects of reading the charts, which a lot of people refer to as technical analysis. Now, before we go deep into the class, there's a few misconceptions about technical analysis that I want us to clear. The first one is this: your technical analysis will not and will never tell you exactly what the market will do next. So get that in your mind. Your analysis doesn't tell you what the market will do next. It doesn't tell you exactly what the market will do next. It only tells you that there's a higher likelihood, meaning there's a higher probability of one thing happening after another. And by probabilities, it means that your analysis will not work all the time. Sometimes it will fail, sometimes it will work, but it is just what it is. It only tells you there's a likelihood of one thing happening over another. So as you go into technical analysis, there is need for humility and reducing your expectations, because the higher expectations, the higher the tendency that you'll be disappointed if the thing that you analyze doesn't play out the way you had thought it would. Why do many people get wrecked or lose a lot of money in trading? They depend too much on technical analysis. And what I mean too much, they're like, oh, I've seen this pattern before. The last time I saw it, I saw this double bottom pattern. The market just flew up and gave me a lot of profit. So now that I'm seeing this pattern, I'm going to risk my entire account on this signal and make a lot of money and just rest. Now that's an erroneous thinking. Why? Because your analysis isn't telling you that the market must behave in this way. That it behaved in this way before is no guarantee that it will do the same thing now. So understanding that is your key to peace. So if your analysis doesn't work out, you'll be like, oh, the analysis failed. We'll wait for the next one. What happens? You're now humble. You're now having the mind of a quiet observer of the market. Not someone enforcing his will on the market, but someone just observing and trying to flow with the market. So if the market says no, you say, oh, no argument, no. Your stop loss is hit, no problem. That is the basic of technical analysis. Now, what is technical analysis in itself? It is the ability to look at price history, the history of an instrument, any instrument that you might be trading. For us now, we're looking at Bitcoin. It's an instrument we're trading now. We're looking at Bitcoin. So our technical analysis tells us that, oh, based on that the market always repeats certain patterns, and whenever those patterns seem to be reoccurring, there's a likelihood that one thing will happen. Meaning, if you see this pattern, there's a likelihood that it will behave this way instead of behaving that way. So your technical analysis now gives you what is called an edge. An edge is the signal that you have to either place a trade or get out of a trade. That's your edge. It gives you a signal to enter the market, rather. That's your edge. So you define your edge following your understanding of technical analysis. Now, having said that, we're going to start from the very basics. Now, this is an instrument. This is a chart of Bitcoin. Can be Bitcoin against the United States dollar or any chart for that matter. Now, market is at a particular price. Let's say it's at, right now it's at 34,800. How can we predict or project that this market is going to rise from here to 40,000 or drop from here back down to 30,000. We do that using our knowledge of the market from the different patterns that we've learned about how the market behaves. And we'll now use that to make predictions or projections about the future behavior of price. So on your typical chart, you have two axes. You have the time axis on the bottom, which is your y-axis, Okay, someone is saying, how can I listen? Well, click on join with audio on your Zoom. If you're on your laptop, click on join with audio at the bottom left corner. Someone please help me teach this guy how to do it on the chat message. I can't be distracted. So just tell him what to do. When you join, click on join with audio. It's at the bottom left of your phone, or dialing with audio. That's what you do. Pretty simple. Sorry for that distraction. Okay, now let's go on. So you have time on this axis. Let's call it the x-axis. Then you have price on your y-axis. Now, time is constant. Time is always advancing. Time is always moving forward, meaning this instrument, this chart, would always be printing more candles or more price data towards your right. Today is 24th of June. So price is forming this. Tomorrow will be the 25th of June. Price will form this again on this side. Why? Time is always advancing. Time is always moving forward. Now, on this other axis, which is your y-axis, you have price. Now, price is not always advancing in the sense that it doesn't always move in one direction. Price can move in two directions. It can either go up or come down, or sometimes move sideways and not have a clear movement, a clear direction. So when price is going up, it is said that that price of an instrument is in an uptrend. Uptrend is trending up. Uptrend. However, when the price of this instrument is going down, like we saw here, we say that this instrument is in a down trend, is trending down, is a downtrend. Now, those are the two axes you have for price, sorry, for a chart. Now, there are certain things that helps our interpretation of price. There are tools that have been developed over time by different traders to get a better view of the market. Now, the first one is what you call the line chart. This is the line chart. Now, the line chart is, if you did science in school, you must have done graph. If you did science in secondary school, you must have done graph, line graph in school. And in creating a line graph, you have your x-axis and you have your y-axis. Now, whatever the data point is on the y-axis, you are now trying to merge the two. So for here, for example, this is the H4 chart. So at the close of every H4 candle, there's a data point from the x-axis, which is time, that corresponds with price on your y-axis. So you get a data point here, and this line is formed, either it slopes down or slopes up, depending on the direction that price is moving. Now, the line chart only takes into account the price of this instrument, in this case Bitcoin, at the close of the time frame under review. Right now, we are under the 4-hour time frame. There's a daily time frame. Let me click there. This is a 4-hour. There's a 1-hour time frame. Time frame simply means the period of activity within the way price moved, either up or down, within a particular time. In this case, 1 hour. So right now, this price seems to be coming down. Why? Because this price was here at some point, but now it's slanting down. It means that at this hour, price went up, but in this current hour, price seems to be coming down. So it might come down and record more hours down here with new time, with the current price here, then maybe shoot up like you see it did here. So that's how price moves. And as you can see, it moves as a wave. It moves as a current, just moving with ripples up, down, that's how price moves. This is very simple. This representing price with a line is very straightforward and direct. But people who trade or people that create trading infrastructure have discovered that this gives limited information, because it only tells you the point at which a market closed, or at which price closed within the time frame that we're considering. It doesn't tell you the details of what price did within that trading time frame. Now, from there, from the line chart, the next one that was created was what you called the bars, or the bar chart. Now, this is your bar chart. Your bar chart was created to be a little more advanced in that it records everything that the line chart has, but then it gives you more information. Why the line chart only records one data point, which is where price closed, in this case, which is somewhere here, this one gives you 4 data points. It tells you where price opened, which is this line. Okay, let me zoom in. So your bar chart gives you 4 data points. The first one is where this market opened, which is this line that points backward. The second one is how high price went within that trading time frame. Remember, each of these bar represents 1 hour. Then it also tells you how low price went within that hour. Then it now finally tells you at what point price closed. So price opened here, went this high, came down this low, but then closed at this point. So if you're looking at the line chart, your line chart will only record this final piece of information. However, all 4 are important in seeing the true picture of what price is trying to print. As good as this is, as the bar chart is, it has its own limitations also, in that traders now felt we could have a slightly more advanced chart that tells us a little more than what the line chart is telling us. So that's when they invented the Japanese candlesticks that was adopted by a lot of people. So here comes the Japanese candlesticks. Now, in the Japanese candlesticks, you have everything on the bar chart, meaning you have the open, that same candle we're reviewing, then this is it. We have the open of price. You have how high price went, which is this wick. You have how low price went, which is this tiny wick under. Then you have where price closed. So in this case, like in the bar chart, if the opening of price is higher than the closing of price, you have a bullish candle or a blue bar or a green bar. You can represent it with any color. You have a blue candle. Now, if the opening of price, which is here on this candle, is lower, sorry, is higher rather, is higher than the closing of price, you have a red candle. So that's how this candle alternates from red to blue like that. And each of this is painting a story. Now, the addition that this gives you is that the body of the candle is now the extra information that the bar chart didn't give you. Now, the way this candle looks also gives you some form of information. Like this one now tells you this is strong buying power that broke through resistance, meaning there was a lot of people pushing this market up. This ones too tell you a story. It's a sign of a likely reversal. Why? Because market is coming down with strong momentum. Yeah, that's a word. The bar chart, the candlesticks tells you about momentum. Also, why? Because the longer the body of this candle, the higher the momentum. So here it tells you that price is coming with a lot of momentum, gets to this area of significance, then begins to form smaller candles, telling you that it's not willing to go down more. Then what does it do? It begins to push up and push higher above the level it was previously. Now, that's the candlesticks. Now, there's a slightly more advanced one, which is your Heikin Hashi. This is it, Heikin Hashi. Now, your Heikin Hashi is also a candlesticks, but it calculates information differently. Heikin Hashi is actually from a Japanese word, which means dual bar, meaning it combines, if you go to your candlesticks only looks at the opening and close of price within this 1 hour, within this trading time frame, which is 1 hour here. So it treats the candles individually. But in Asian Haki, it is called, or Heikin Ashi, or whatever. I'm not a Chinese man, pardon me. Or whatever, is called dual bar because it merges two candlesticks and try to give you a story about the activity of price in the last two candlesticks. So let's go to this. So, okay. So now it reviews this one, then decides which color the candle will be. How does it do that? It combines the closing price. It takes the closing price, the opening price of this candle, takes the closing price and the opening price of this candle, adds the two together, then divide it, add the opening and the close together and divide it by 2. Yeah, it takes the opening and close of this, adds it to the opening and close of this, then divides it by 2 and print a color based on where that price closed. So for example, here now, you can see that this candle here is pointing at 34,821 because it's looking at this candle as a single candle. So it's taking this price from here. Now let's go to Heikin Ashi. You see a little difference. So Ekinashi, where are you? So this is Ekinashi. Okay. Can you see that it's showing you this data at a different point? Okay. Now the real candlesticks, which is Japanese candle, is this red one here. The red one, price is at 34,871. But on Heikinashi, price is at 34,857. And why is it so? Heikinashi is combining this candle and this current candle to determine what the average closing will be. So that's what it does. That's why if you compare this, you can see that all these candles are just forming blue, 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 blue. It means that overall, these last two candles have been going higher. But then if you put it beside your Japanese candlestick, which is this, you will see that you have series of red candles in between. But those red candles are just noise. Heikinashi is telling you that those candles that you see are just noise. Are just noise. Let's see this. Are just noise. Can you see? Just noise. Why? Because everything overall is still going up. So that's what you can actually focus on the average of the two candles and the overall direction that they are going. So it will keep giving you blue bars, blue bars, blue bars, blue bars. So based on how you want to trade, you can now decide which one you think will work well with your own trading strategy. With your own trading strategy. So that's it about candlesticks. Now we'll look more into how it is being used, how to use them, how to apply them to your trading. Thank you for listening. Thank you for joining this class. See you in the next one.